Hey everybody, welcome back for another episode of The Remote Real Estate Investor. My name is Emil Shore, and my co-hosts today are
Tom Schneider
and Mike Laubbaum.
And on this episode, we're going to be talking about all the doom and gloom headlines you may be reading out there. So lots of YouTube channels, lots of articles out there are saying there's an impending crash. And so the three of us are just going to weigh in, tell you what we think, tell you how we think you can navigate this and come out ahead. So let's hop into this episode.
I think it's important to just start off by saying that this is not a prediction. We don't have crystal balls. It's just so that everyone's been talking about it. We were talking about the episode. Everyone's been chatting about this impending crash. So we said, let's talk about what you can do. And this is applicable really for any crash, whether it's tomorrow, 5 years from now, 10 years from now. These are just, I think, solid and sound principles that we plan on using to insulate ourselves from a crash.
Definitely. And anyone who says they know when the crash is happening, just run the other direction. Anyone who tells you, here are some easy, here's the easy no work way to make money, run the other direction. So but anyways, excited for this episode.
Well, let me ask you guys this. When did you start investing? When did you guys start investing in real estate? What year?
Like 2012?
Yeah, about 10 years, 2014.
Okay. So maybe you guys probably didn't see it as much. I started in 2017. And I remember in 2017, I would probably see that headline at least once a week of another bubble coming, market crash, like YouTube videos, headlines. That's since 2017. Stuff. Yeah, and this is 4 years ago. And so I think my hypothesis here is it's clickbaity. No one has any idea. At some point, right, someone's going to be right. If you just keep saying every single month a crash is coming, you say that for 7 years, I guess at some point you may be right. And then you're like, see, I told you so.
I'm a genius.
Kind of, sorry, I'm diverging a little bit. I love that. That's a great point of just saying that every day. I heard this story about fund managers that would have tons of different diverse funds and one would hit and then they would market everything on that one diverse fund. I don't know, kind of a similar, sorry, distracted. Tom, see, squirrel running by. Go ahead, Emil. Sorry, keep going.
No, I mean, this is just casual conversation. I just think it's clickbait. I don't think anyone knows when it's going to happen. Real estate moves in cycles. Yes, there's going to be ups and downs, right? This kind of trajectory we've been on where things have only gone up, that is not sustainable forever. None of us, I don't think, are going to say that real estate only goes up or that anything only goes up. Things come down, but I think it's a fool's errand to try to predict when those things will happen.
Ooh, fool's errand. Great saying.
Totally agree, Emil. I think there's a lot of things in the world you can worry about. I think that worrying on timing exactly the crash and the idea of trying to know that is just unrealistic. I think when we get into the meat of the episode, it's about, okay, what can you do as an investor to put yourself in the best position to weather the storm and perhaps even come out even stronger.
Yeah, I'm with you.
Yeah,
I second that.
So let's just talk about what should you be doing? Well, what do we do? Not what should you be doing, but how do we navigate these things? So Michael, Tom, whoever wants to kick it off, how do you approach investing even at a time like this when values have never been higher?
Michael, would you like to go or would you like me to go?
Yeah, I'll go because you always steal my thunder. So
I totally was still, I had a bunch of thunder already.
I can see there I hope he tells me to go first so I can steal his thunder yet again.
I'm sitting on the edge of my, yeah.
So,
all right, go ahead.
So one thing that I'm doing, and this might be counterintuitive, but I'm actually levering up as much as I possibly can. Because what it does is we're kind of at this unique time in that, like you mentioned, Emil, values are so high and interest rates are so low. And so there's that massive spread if you've got equity in your property that you're able to take advantage of and get a lot of it at a very low interest rate. And so that's what I'm doing, and I'm getting some dry powder in my back pocket to be able to utilize if there is a crash. If there's not, well, I'm just going to continue investing. And I'm probably not going to wait on the sidelines for very long before redeploying that capital to wait and see what's going to happen. Because if you find a good deal, if the numbers make sense, great. And this is something that we've said all along. This is something that I've been preaching all along. Let the numbers do the dictation for you. Let the numbers be your deciding factor. So I'm grabbing as much cash as I can while the values are still high, and I'm trying to get as long of a term as I can on the debt. And so that's what I'm in the process of doing right now.
I love the contrarian take you have. A little devil's advocate here. What, say there is the crash, right, that we are talking about, are you concerned at all about the value of your properties being underwater?
Yeah, it's a great question.
Since you're maximizing your debt.
Yeah, it's something that Emil and I have talked a lot about, and I think we've shared on the podcast as well. I'm less concerned actually if the value of the property goes underwater, because at the end of the day, the value of the property is really only meaningful in a couple of different places. One is from an ego perspective, talking about your net worth, but two is from if a transaction is to occur on that particular property. And by transaction, I mean either a refinance or a sale, because I already own the thing, so I'm not buying it again. But if I need to refinance the property and it's underwater, I'm in trouble. If I need to sell the property and I'm underwater, I'm also in trouble. But in light of those two, barring those two events, I believe that even if it does go underwater, the value will come up over time. And as long as there's cash flow to support the debt service and pay myself, I'm okay taking on that risk. For, again, the potential upside of I'm putting cash in my pocket today, so if there is that crash, I'll be able to buy into that crash down the road and hopefully hedge my downside.
Love it, Michael. Excellent answer. Emil, do you want to jump in? And I'll take up the what if there's any kind of scraps at the end after. Yeah.
Clean up.
The scraps at the end. No, I agree. I think that's the number one thing. I wouldn't. This is me personally. I'm not going to invest in anything that is me banking on appreciation to make my return when valuations are high. I would only purchase something that I know I'm going to cash flow to be able to cover my debt, like Michael talked about. Because even if the value goes down 20, 25%, as long as I'm still able to pay my bills, I'm still able to make some money on top of it as well, it doesn't really matter to me what the value is. I'm planning on holding long term. So my strategy, what I would avoid is going and buying a property in hopes of it appreciating another 20% like it has in the last year or so.
Awesome. So I'll throw a couple of other tidbits in there. Just like Michael said, making sure, well, the actual value doesn't matter as much, but just making sure that you have some buffer in the cash flow is important to be cognizant of. Just because you don't have a lot of control of the value, but at what you're buying for and the way that you're using debt, you have a little more control of that cash flow. So if there is a downturn, you need to be able to weather the storm. The other thing I would say is making sure that you have the right reserves in place as a cash backstop. Sometimes CapEx comes up. You don't, the worst thing that can happen to you as an investor is you need to not panic sale, but sell out of necessity and do it quickly. And you can prevent that from happening, controlling your exit by making sure that you have the proper reserve. So that's like the biggest way that you can get in trouble with this downturn is just needing hafting. Did I just make up a word there? Hafting. Yeah, definitely made up a word.
Definitely made up a word.
I think it has a punch to it. It's kind of fun to say. So my number one tip is just look at your reserves, make sure you have 6 months, whatever that number to make you feel comfortable. If you have some older properties that have some potential roof stuff, maybe you up the amount of dollars you have. But to Michael's point about cashing out and having some, quote unquote, dry powder on the sideline, should there be some sort of a downturn, you can be there. But to be honest, I think there's so many investors with that same attitude, but maybe I'm wrong that, are kind of cashing up and ready to pounce. Perhaps I'm wrong, but for that reason, I think it also kind of provides a little bit of a backstop. If prices were to go down, I think there is some money on the sideline ready to go. But anyways, as far as kind of a way to hedge kind of the downside of risk is just making sure that you have proper reserves. And I think I repeated that same point like 3 times, but repetition is the mother of learning. So
it's driving it home. Tom, what are your thoughts on getting access to that capital via a cash out refi or via lines of credit?
I love it. I love it. I love it. It's like, I feel like Elf talking about maple syrup. Anyways, it's, I think getting access to it is great. And for the market dynamics that Michael spoke of really low interest rates, as well as high price appreciation, I too am very comfortable getting as much debt as I can, just making sure that the rent covers the loan servicing and the debt payments that I have. So I feel the same way that Michael has. Is right now is a great time to get that money out and to either reuse it, right, or just keep it in the background.
But of those two, cash out refi versus HELOC or line of credit, do you have a preference for what you would prefer?
I think long-term fixed debt is great. I mean, on my primary, like I have a big HELOC that I'll use for some stuff I'm doing around building a little studio shed, a little office. But for my rentals, I think getting that long-term fixed debt into place, and who knows, maybe the interest rates go down in the future. Great, I'll refinance. And if they go up, great, I'm already locked in for really low debt. So that is the situation there. I think the one other thing I'll talk about on this topic around, hey, maybe the great market bubble burst is happening tomorrow or next week or whatever. We don't know when that is. So, if you have acquisition plans, I wouldn't hold your breath and just wait for that to happen. I would, go through the process of building out a buy box, establishing what you want to buy, and then, continue to underwrite properties until they fit and they make sense. And, perhaps there's nothing that hits your buy box like at this time, but I wouldn't, basically at a high level, I wouldn't turn off your acquisition machine if you're in like an acquisition mode, trying to wait and timing that particular cycle, just because, as we said, it's impossible.
The other thing that I think about that it seems to be on everyone's mind and everyone's talking about, and it could very well be clickbaity too, but I think that there is some truth to this, is the inflation is coming. On a prior episode with Jason Hartman, we spoke about inflation in great detail. And for those, I highly encourage anybody who's interested to go listen to the episode. At a high level, it's basically you're locking in a payback rate in dollars, and then the value is likely going to be floating up. So we get to pay back the loan with cheaper dollars over time. So again, highly recommend going to check out that episode, but that's just another reason, another benefit to taking on debt, and the longer term, the better. And so for those two reasons, I'm out. I'm in. I just watched Shark Tank last night.
So you're saying that's why you are another big reason why you're going out and basically levering up as much as you can.
Exactly. To get the cash backs up, like Tom was mentioning, to have some dry powder, and that inflation is coming. I would probably be doing something similar even if there wasn't all of this talk of a crash. My strategy really hasn't changed. I just think it's kind of good practice and nice to have. And again, with the interest rates being so low, it's like, how much better do you need it to get for you to go take the cash out?
Yeah. If I had a crystal ball, I doubt we're going to look 5 years in the future and see lower interest rates. So probably a good time.
Yeah.
My final point is, and Michael kind of alluded to it as well, is at least for us, we're longer term hold guys. And with that type of a strategy, there's just a little bit less risk for these market fluctuations, in that, we're planning to hold these to as retire early, all that good stuff. So, if you're a flipper, I would be a little bit more concerned around big changes in the market values of the houses. But as a long-term holder, it's less risky, I would say.
Agree.
What actually happens is a lot of times flippers end up turning into holders just because they can't sell the property for what they're worth. So that's how a bunch of long-term buy and hold started back in, late 2010s crash.
All right. With that, let's sign off. Thanks everyone for tuning in. Hope you got some value out of this one, and we will check you out on the next episode. Happy investing.
Happy investing.
Happy investing.